Nick, very good to see you. I'm glad that we have time today to talk through recent headlines and this recent market volatility. Concerns about a cooling US economy led to a market rout in early August, with the Dow down as many as 1,100 points. The market has since rebounded for the most part, but I'd like you to respond to this recent volatility as we take a look at this chart from FinViz, which shows the S&P's 1-month performance.
Right. So looking at this chart, it doesn't even look like there was a rout in the
Right.
market. And, for some people that don't pay attention to, all of these daily movements or inner hour movements of the stock market, you may not even realize, that there was a rout. But we did see, a extreme movement in volatility back in early August. And since then, everything's kind of leveled back out a little bit. And we're going to see these from time to time, as more access to the markets, more movements, headlines are driving a lot of this. All of that kind of stuff is, number one, unpredictable. We're going to see, trading algorithms, throw off the markets a little bit here and there. The important part about that is to remain calm and understand the plan that you're in and walk through what's going on in the market at that specific point in time.
Right. Always sound advice. It's just hard not to act like an emotional human sometimes. So, as
Exactly.
you mentioned, though, it's been a very strong year for the markets, especially for the tech sector. But for that correction that we saw, was that related in part to the concentration risk that we've talked about before, where 82% of the movement that we see in the market is due to only 10 stocks?
Right. So when we look at the diversification of the S&P 500, obviously there's a number of stocks, that are in there, but we're concentrated to just a small portion. As
Hmm.
this chart right here shows, 10 stocks equal 82% of the S&P 500. So as those 10 stocks go, pretty much so does the rest of that index. We're going to see the S&P move more heavily on a day where those stocks are trading, a little more extreme. For example, today, NVIDIA is down, pretty substantially. So we're seeing the markets, tag right along with that. That kind of stuff's going to happen when you're in a market cap weighted index, and such as what you see right there on that chart. There is a lot of green on that chart, but it's a lot of the smaller boxes, a lot of the smaller
Right.
companies, of the S&P 500. Some of those bigger companies, are having a little bit more of an extreme day. So yes, the concentration risk, in there is, a big factor, and we want to, try to minimize that risk as much as possible. But we also want to run with our horses, the things that are doing well. I tell people all the time that we're not going back to typewriters or stone and chisel. Technology is probably here to stay. The internet's here to stay. AI, all of that kind of stuff. We're going to continue to see that development of it. So we want to be a part of those tech companies, but we also have to, try to minimize some of that risk as well.
Right, right. Which leads us to our next question. Of course, the S&P 500 is not a well-diversified portfolio. How did a well-diversified portfolio withstand that recent volatility?
Right. So, like I said in the beginning, a lot of people that, probably didn't, watch it on a day-to-day basis really didn't feel, too big of a setback. And, since then, we've actually seen it all start to come back. So on days where there is extreme volatility, we see those tech sectors, start to take a big hit, or any other sector, for that matter. We've got other parts in that portfolio to be able to minimize some of that risk. We've got other fixed income positions and structured notes and so forth to be able to have that steady income for the retirement needs.
Hmm. So this is kind of funny, Nick. When all of this was happening, I happened to be on Google and I was typing in "should I?" and the first option on that drop down was "sell my stocks right now." So clearly, a lot of people were feeling very anxious. But what do we need to keep in mind when we hear those scary headlines?
Yeah, when I went through my CFP training, looking back on it, I really wish there was more of an emphasis on behavioral finance. And, the behavioral side of it is, as soon as we see a bunch of red in the market, everybody thinks sell, sell, sell,
Right.
and everybody wants to wait until it's green, to go back and buy it. When we walk into a store, it's not that we go to the clearance aisle and think, wow, all of this stuff is, 15, 20, 30% off. Well, I'm just going to wait till it goes back to, a normal price to full resale till I buy it. No, most people walk into the store and they look at those clearance racks and they will buy it while it's on sale. But it's the opposite, when it comes to the stock market. Nobody wants to touch, the things that are on sale. We've got to find a way to, add to some of those portfolios with quality pieces. I'm not saying buy something and try to catch a falling knife as it's going to the ground. But if there's, some quality investments that are out there that are at a discount, I think it makes perfect sense, to diversify that portfolio and buy in.
Right, right. I'm really glad we got a chance to talk this through, especially because it is an election year. We expect more volatility, and it all comes back to having a plan, not going to Google for financial advice the day of. So, if
Yep.
somebody would like your help, Nick, creating that financial plan, what's the best way to reach you?
Yeah, they can reach out to us online at eikenberryretirement.com. There's actually a link on there. They can schedule an appointment or find some of these videos, on there as well. Or they can give us a call, 937-498-1128. We'd be happy to set up a time to discuss, their current plan or, looking to schedule a new plan.
Great. All right, Nick, thanks so much for your time today.
Thanks, Erin.